Welcome to our financial management class. In previous classes, we discussed what is capital budgeting, what are different methods of capital budgeting, and we also tried to understand the payback period method, which was the first method under the category of traditional method. In payback period method, we tried to understand that how a manager can calculate the time of recovery of an initial investment. And there was two situations we encountered. The first, when the cash inflows were even, and the second condition or situation where the cash inflows were uneven. Now, today we are going to start the second method, which is average rate of return method, or which also known as accounting rate of return method. But before we formally start that method, I need that we should know that why actually we need another method. Because as per our understanding of payback period method is successfully answering questions such as when I will be able to recover my investment, and if there are two or three investment opportunities, which investment has a shorter payback period, and definitely that will be the ideal one or attractive one. But yet, payback period method has certain limitations. As in my very first lecture, I explained that none of the method is ideal or none of the method is, uh, you can say that, outdated. But there are certain situations where one method can be applicable, and there are certain situations where other method will be applicable. And to explain further, I actually explained in a way that these methods are arranged in a form of ladder. That first method, then to address the limitation of first method, there will be a second method, and then to address the limitation of both first and second method, there will be a third method, and we will move in a hierarchy of methods. So now, first we will discuss the disadvantages of payback period method or limitation or shortcomings of payback period method. And then from these shortcomings, we will move forward towards the second method. The first disadvantage of payback period method is that it ignores all the cash inflow after the payback period. If you recall our example of $75,000, the first year was 10,000, second year was 15,000, third year was 20,000, fourth year was 25,000, fifth year was 30,000, and that was payback year. And here we actually finished our calculation, and we didn't bother that either there are some future cash inflows. So the first shortcoming is that we ignore all the cash inflows. The second, that it does not consider the total benefit from the project. As it is also linked with the first point, as it ignores all the cash inflows after payback period. So basically, it is unable to provide any information about the total benefits from the project. Third, it only finds the recovery of investment and not the profitability. And it is again linked with the first and second, as it is only concerned with the cash inflow till the payback period. It ignores the future benefits. That's why it does not provide any picture about or information about profitability. And fourth, it ignores the concept of time value of money. It means it does not provide any information how much I will be generating from that investment, and does that inflow will be adjusted for the time value or not. And lastly, it also ignores any scrap value of the project. So, similarly saying, or simply saying we have three shortcomings. First, first it provides no information about the benefit and profitability because it ignores all the cash after the payback period. So it is first. Second, it is not adjusted for the time value of money. And third, it ignores the scrap value. Now, to address the first limitation, which is that it provides no pictures or no information regarding profitability, we have another method which is known as average rate of return method. Average rate of return method is simply explaining to you prior to having a formal introduction. This method is one of the capital vesting methods which provide you authentic information about any investment project related to their profitability. So let's formally discuss what is average rate of return method. Average rate of return method, which is also called the rate of return method or accounting rate of return method, introduced to overcome the disadvantages of payback period method. Now here it's clear that we introduced it to overcome the shortcomings or disadvantages of payback period method. It considers all year earning. It means it considers the cash inflow after the payback period. It's based on conventional accounting concepts, so accounting profit is included. The rate of return is expressed as a percentage of the earning. And the earning is basically earning after depreciation and tax, which is actual earning. That for example, if you have a operating profit, and from operating profit you subtract depreciation and then tax, and finally you get the actual accounting profit. So it take into account the actual accounting profit. Now, how to calculate? The first formula for average rate of return is simply, or the first situation, and the first situation is where there is no scrap value. Now here ARR is equal to average income after tax and depreciation divided by average investment multiplied by 100. And average income after tax and depreciation is the ratio of total return and expected life of that project. And average investment is equal to original investment divided by 2. Now let's solve a question for this. Suppose there is an initial investment or cash outlay of 4,000. Expected life of a project is 4 years. And another project, which is project B, the initial investment is 5,000 and the expected life is 4 years. The stream of cash flow is as that first year it will generate 2,000, second year 1,500, third year 1,500, fourth year 400. And the total cash inflow is 6,000. It means we have invested 4,000 and we have generated 6,000. Now, the second investment is that we have invested 5,000 and the first year cash inflow was 3,000, second year cash inflow was 3,000, third year cash inflow was 3,000, and in fourth year it was 1,000, and total we have generated are 9,000. Now, we have to find which project is favorable or which is unfavorable. Looking at the data, we have to find average income and average investment. Average income is total return by expected life and average investment is original investment by 2. So now we are solving it for project A. So let me again scroll back. For the project A, our initial investment is 4,000, our total income is 6,000 and time is 4 years. our total income is 6,000, initial investment is equal to 4,000, and time is equal to 4. Now, average income is the ratio of total return to expected life. Total return is 6,000, expected life is 4. So our average income will be 1,500. It is basically average income per year. So averagely we are generating 1,500 per year. Average investment, original investment divided by 2. So our average investment is 2,000. So our numerator is average income and denominator is average investment. So we have simply divided 1,500 by 2,000 and our accounting rate of return is 75%. Now for the project B, our initial investment is 5, our total income is 9 and our life is 4 years. Let's start it for it. First, let me write in the data. Total income is equal to 9,000. Time is equal to 4. Initial investment is equal to 5,000. So average income simply by total return or total income divided by expected life, which is 2,250. Average investment is equal to original investment divided by 2, which is 2,500. By taking ratio and putting it to the actual formula, it is 90%. So the ARR of project B is 90%, and for A project A it is 75%. So we will go with the project B. But the question is, what this 90% say? It says that for every $1 you will earn $0.9, and here for $1 you will earn $0.75. So this investment is favorable and we will pursue. Now the second case where you have scrap value or additional working capital. So our initial formula was accounting rate of return or average rate of return is equal to average yes, average income by average investment. So now the formula for average income will remain same, but for average investment we have a different formula. For average investment, we first find a ratio between the difference of original investment minus scrap value by 2, and then we'll add additional working capital and scrap value. In our case, we are only dealing with scrap value. Okay, so now let's solve a question. The cash outlay or initial investment for a project is 50,000, and for project B, same as 50,000. The expected life is 5 years, 5 years. Scrap value 7,000, 3,000. Cash inflow for first year for project is 6,000, 9,000, 10,000 for third, 12,000 for fourth, and 14,000 for five, and the total cash outflow is 51,000. And similarly for project B, the first is 7,000, 8,000, 10,000, 12,000, and 16,000 respectively for the 5 year, and the total cash outflow is inflow is 53,000. And it has also the scrap value of 3,000, and it has scrap value of 7,000. Now let's solve it. The formula for average income remains same. The total return for project is 51,000 and life is 5. So it is 51,000 divided by 5 is equal to 10,200. And for average investment, the original investment was 50,000. Scrap value was 7,000 for project A. and additional working capital is 0 and scrap value again is 7,000. Solving for this, we will get 28,500. So dividing 10,200 by 28,500, we will get 35.80%. And for project B, solving similarly, we will get 40%. So in this case, the project B is higher than the project A, and hence project B may be chosen. So this is average rate of return method, which address the limitation or the shortcoming of payback period by providing information to an investor about the cash inflow after, or by including the cash inflow after the payback period, and by also explaining him or providing information about the profitability of a project. Hope so this video will be helpful for you. We have uh, 2 or 3 numerical questions as an assignment, which I will upload on your Slate and Moodle. Kindly solve them and submit prior to the next class. And in next class, we will discuss about the next method, which is related to the time value of money. Thank you so much for your time.